Welcome back, listeners, to the Mindful Living podcast, where we explore how to cultivate peace, purpose, and prosperity in every aspect of life. Now, today's episode is Money Talk, but make it mindful. We are diving into income independence with none other than Steve Selengut, a 40-plus year investment guru, author of Retirement Money Secrets, and the mastermind behind a sustainable and secure income methodology. Now, listeners, imagine generating enough spendable income that market corrections and interest rate hikes don't scare you, they excite you. Yeah. So buckle up, everyone, because Steve is here to blow your financial worries out of the water. Let's get mindful about money. Steve, welcome to the show, and it's an absolute honor having you with us today.
Well, thank you. Thank you for that wonderful introduction, and hopefully we won't blow anybody too far out of the water, but but we'll give them something certainly to think about.
Definitely. Steve, let's start simple. What does income independence mean, and why is it such an important goal?
Well, I guess people talk about financial independence a lot,
Yeah.
and a lot of people will look at, let's say, if they're investors, they'll have an investment statement from their provider, and it'll show a large number. And when it gets to be a certain number, depending on who you are, you'll say, I've made it. I'm financially independent. I think I've got enough money here to take care of myself and my family, and whatever I want to do, I feel that in a secure position. Now, that feeling of financial independence may disappear in the event of a bad financial crisis, like the ones in 1987 and 2000 and 2008, and again in 2020, for a simple thing like a health scare, but that's a different type of thing. Income independence, you don't necessarily have to have that huge amount of money. The more you have, the better, obviously. But what you have is the income being produced by that money, by those investments, by those big numbers. And when you focus your investing on the income that you are producing, it actually can be the same regardless of the size of those total asset numbers. For example, my portfolio is generating, let's say, 9% right now. If the market goes down 20% tomorrow, my income is not going to change. It's not likely to change at all. So instead of getting all excited and saying, geez, I got to sell and get out of here, or this means we can't go on that vacation, honey. Instead of having that type of reaction, I'd be sitting here, and I am sitting here, as you can see, rubbing my hands together saying, wow, I have better income investment opportunities now than I did before the market went down, because prices are lower. Companies and employers can't change their payouts on bonds and preferred stocks and things like that, and typically don't change their dividend distributions. So I'm going to continue to make the same amount of money coming in as when the market was much, much higher. Okay. So on the other end of the equation, if the market goes up and up and up, in my methodology, I take profits, capitalizing on the gains in market value so that I can buy more securities and add to positions so that I'll be making even more money, not just looking at how pretty my portfolio is getting in market value. So that's
Mhm.
income independence. The portfolio produces more than enough income to let you do everything you want to do. And when you
Mhm.
talk about a healthy mind, when you talk about emotional well-being in the face of all that happens, a good solid base of income from your investments, I think, is a really big help in producing that kind of a status, don't you?
Yeah, I agree. I agree. Totally agree. It's one of the basics of a healthy and fulfilling life, financial aspect. Because when I was having a discussion with one of my guests about the six pillars of life. I was talking with Kundan Kumar. Shout out to him. So one of the key pillars was financial. So definitely, it's a very, very income independence is very important to be aware about. And I think it is definitely an important goal for everyone.
Right.
Great, great. So, Steve, can you walk us through the principles? You have created something which is called Retirement Money Secrets Methodology. So, can you walk us through the principles behind it?
Sure. The methodology is really, Retirement Money Secrets is the name of my book. And in it, I describe um, basically, I think it's six principles of
Okay.
investing. Two of them are attitudinal, meaning they're about how you look at things in general, and four of them are ways to reduce the risk of your
Mm-hmm.
investment portfolio. So, covering those first, the first, and I call this the QDI plus PT. So it's for quality,
Mm-hmm.
diversification, income production, and profit taking. So the four ways to
Mm-hmm.
keep your risk level when you're investing, particularly when you start investing, is to make sure you have a way of defining the quality of what you're investing in. Every entity that you invest in should be around for at least 5 years, to have proved itself. It should pay a dividend of some kind to you, um, because you're an owner of the company. If you're buying stocks, or you're a you've lent, if you're buying bonds and things like that, you're actually loaning money to the corporation or to the government entity that you're buying the security from. So you want them to pay back. They're either paying dividends or interest to you, and you don't really want to go to a company that's not paying anything. In the case of closed-end funds, which is what I use as my risk minimizing security, because these are funds of multiple securities,
Mm-hmm.
literally hundreds of securities that have been around more than 5 years and pay significant distributions because they're trust
Mm-hmm.
vehicles, and they have to pay out 95% of their income to shareholders instead of keeping it for the CEO and the other top executives. They have to give it back to the shareholders. Um, so when you look for quality, you want to look for these things: the payment, how diversified the company is, and the products it has to offer to other people. In closed-end funds, how many different companies are within that fund, and the average for closed-end funds is in the hundreds. So when I'm buying a portfolio of bonds, they're bonds from hundreds of different communities or hundreds of different corporations, and stocks would be, all over the world, stocks from all over the world, every place. Okay. So that's the quality entity of the four things to reduce risk. Um, Income or diversification probably is the second most important. Make sure you have a diversified portfolio of different securities. In my case, each and every selection, each and every security is in itself well diversified, but I want a portfolio that is a diversified portfolio of diversified portfolios. So it's a double layer of diversification, the way I talk about it in the book. Very important never to have as much as 5% in any one security.
Mhm.
In my personal portfolio, I don't have anything that's more than 2% of the total assets in my portfolio. The third, let's call it pillar of risk minimization, is income production. And I mentioned that as also being a quality element. But when you start talking about the actual income of something like a closed end fund, we're
Mhm.
talking a range of paying at least 6% minimum. And at current levels, it's more like 9 and 10%. So
Mhm.
that's the type of income you want. You don't want anything that pays less than 4%. And the reason for that, um, in the financial services community, um, advisors always talk about the 4% rule, that when you get to retirement, you're going to have to take 4% out of your portfolio. And I think that 4% does not include uh, the 1% or 1.5% that the advisor's taken out of the portfolio, you know? So maybe your real expenditures are 5.5%. So so when I say you have to have income coming into the portfolio, you want everything to be paying more than that 4%. Uh, and if you're doing it yourself, and then more than 5.5% if you have an advisor doing it for you. Uh, Rarely will you find an advisor who sets up a portfolio that's yielding those kind of numbers, and that's unfortunate. But you can do it. You can do something about that either by doing it yourself, which I know a lot of people will be afraid of, or by insisting with your advisor that he produce you at least 4% or more in income, or else you're going to find somebody else that will. And that might get him to actually, you should just buy him a copy of my book and say, here, this is what I want you to do. Something like that. Then the final risk minimizer is perhaps the most ignored by investors because they tend to fall in love with something that goes up and they become angry with something that doesn't go up. So they constantly are selling um, securities at a loss and just holding on to securities that go up in price. The problem is that just going up in price doesn't generate any more income. It just builds the ego, so to speak. It makes you feel good. But until you capitalize it, it doesn't do anything for you. It's just like you had a store and you had stuff in your store and people came in and they want to buy it and you've already set a markup. You're not going to say, no, I think the price is going to go up tomorrow, so I'm not going to sell it to you today. You know,
Mhm.
you're not going to do that. You're going to take your profit and then you're going to find something else to put on the shelf, not something else you can sell. And that's really what capitalism is all about. And the financial community, I think, in its great era, is encouraging people to just hold on to stuff when it goes up in price and not capitalize on it, which is exactly the opposite of what the companies they're investing in are doing. It just doesn't make a lot of sense to me. So profit taking becomes the second, the final risk minimizer. Then the two other things, one is a mindset um, of changing your focus from the growth in the market value of the securities you own to growing the income that your portfolio is producing. That's what produces the income independence. If you have $100,000 portfolio today, it's producing 5%, $5,000. If the value goes up to 150,000, it's still producing $5,000. Now, if you take that 50% gain and put it in and sell and take the gain, now you have 150,000 invested or that you can invest and it's still generating 5%. That's 7,500 instead. The market goes down, you haven't gained anything if you haven't taken your profit. So the mindset of changing from an income focus, uh, from changing from a market value growth focus to a growing your income focus is critical to becoming income independent. Then finally, there's the recognition that all financial securities, stocks and bonds, are volatile in nature and that there's a market cycle that impacts both of them. And for example, right now it's clear that the stock market is very close to its all-time high. It struck each of the major indices struck at least 50. Let me see if I'm right. Yeah. Yeah, between 40 and 50 new all-time highs in 2021. Now they're all a little bit below that level, but they're still much, much closer to an all-time high than they are to even a modest low. You know, they're still seriously above where they were 2 or 3 years ago. Okay, so when you're when you knowing where you are in the market cycle, like knowing that we're very close to a high in the stock market, and you just took a profit and you got all this money to reinvest in the stock market in an equity closed end fund, you don't want to buy as much of it as you would if the market were down and the same quality level company was much lower in price. You know, you'd buy it, so you don't buy as much of it when it's high. You still can buy it. Um, you know, you just don't want to get to the point your entry point is like 1/3 of the 2% or 3% that you want to have. So you start at a lower point when you're doing equities at a high and a higher, and you could when they're at a low, you can do your normal amount. And right now it's just the opposite in the income side because income security prices are still quite low. So if your initial amount that you target is, let's say, $3,000, you can certainly put that much in because prices are very low and they're more likely to go up, i.e., interest rates are more likely to go down than they are to go up uh, currently, according to the news and so on. That that atmosphere that atmosphere may change and price movements in recent days makes me think that it will change to uh, not likely to go down as much as people think it will.
Mhm.
But we'll see what happens. And the and the change in the government in the United States coming up by the end of this month is going to be very critical in what happens in those particular areas. And that's not something to fear, it's just something to be aware of. Um, the Republicans, I think, would like to see interest rates go down more, even if it's not appropriate behavior, because if they do it at a time when inflation is still too high or threatening to go higher, that's just going to make it worse, you know?
Some great, practical insights and a very detailed explanation about the principles. Steve. So before we wrap up, I understand 30 minutes is not justifiable for such an important and crucial discussion. But before we wrap up, Steve, for someone who is just starting their journey toward income independence, irrespective of their age or the point of point at which they are right now in their lives, what are the first steps they should take?
Oh, well, first, I think they should go, read a good book that talks about income
Yeah.
because income and quality are very closely associated with one another. You don't find a lot of income coming from new companies, raw companies, companies that aren't profitable. You're not going
Mm-hmm.
to find too much income being produced by them. So you'll if you focus on income and focus on a type of security that whose purpose is to generate income, then you'll gravitate towards the closed-end fund vehicle, and they're safer types of funds than either ETFs or mutual funds, and they
Yeah.
produce more income, and that's a good place to get started because they're the income is dependable. Their price fluctuations do not typically impact that income, and you don't have to worry so much about it as you would otherwise. So,
Mm-hmm.
so that's what I'm saying. Start there. Read the book. Find out about closed-end funds. There's a website called Closed End Fund Connect where you can actually identify different closed-end funds that you can investigate on your own. You want to focus on the consistency of the dividend pattern more than on its price movements or things like net asset value and stuff like that, because price movements are really just based on supply and demand. And what you're really most interested in is the yield. That doesn't mean you want to pick all the highest yields. You want to have a diversified portfolio. So you'll go with different types of securities. Some will have lower yields than others, but but they should be no lower than 6% at this point to be interested in them. But that's what I would recommend. The book talks about this closed end fund connect. You'll get the link to it, and you know, go slow, go slowly. When you're just starting out.
Absolutely. Great, great, Steve. That was such an informative and very simple yet very you know informative discussion. So, if our listeners they want to connect with you and also check out your book, The Retirement, Money Secrets, how they can do that.
They can contact me through the incomecoach.net, which is my website, and it talks about the type of services that I provide. It also introduces a community that we've developed for teaching people how uh, to manage their income production and their investment portfolios in an income focused manner. And it's called the RMS Income Investing Community, and it's open to people who have read the book and have some idea of where they're going, and they can raise questions in this group. And right now, there's over 200 members. We just started it in December, but there are 200 members, and from what it seems, they're very willing and able to answer people's questions. I, of course, participate in the discussions, and we conduct a lot of Q&A type meetings where we answer questions directly.
Great. We'll have all the details mentioned in the show notes. And listeners, what a journey today. We just had a masterclass from Steve Selengut in building a future proof financial foundation. So, Steve, thank you so much.
My pleasure. Nice talking with you, and I
Yeah.
hope you're feeling better.
Thank you. Thank you so much. And listeners, whether you are gearing up for retirement or just starting your income independence journey, remember, mindful money choices lead to mindful living. So don't forget to check out Steve's book, Retirement Money Secrets, and also his website. You can refer the show notes along with this episode. And of course, for a deeper dive into his proven strategies. And if you found value in this episode, share it with someone who could use a financial boost. or just loves nerding out about money. Until next time, this is your host Sana, reminding you to stay mindful, stay curious, and always invest in yourself. Thank you.